the rule that changed an entire economy. It started with a sentence buried deep inside a policy document. No headlines, no urgency, just a rule that looked harmless, technical, boring, easy to ignore. But within a few years, it would reshape an entire economy and redefine how power, money, and opportunity flowed. This story matters now because economies don't always change through revolutions or crashes. Sometimes they change through rules. Quiet adjustments, lines of text that alter incentives, behavior, and risk without anyone noticing until it's too late. To understand how fragile prosperity can be, we need to revisit the moment one rule quietly rewired everything. It began during a period of stability. Growth was steady. Inflation was manageable. Confidence was high. Policymakers believed the system needed fine-tuning, not reform. The goal was simple: encourage efficiency, reduce friction, and unlock faster expansion. The rule was introduced as a modernization, a way to remove outdated constraints holding the economy back. At first, the effects were subtle. Businesses adapted quickly. Capital flowed more freely. Credit became easier to access. Investment surged into sectors that had once struggled to attract funding. Productivity ticked upward. On paper, the rule looked like a success. Commentators praised the decision. Leaders pointed to early gains as proof they had done the right thing. But beneath the surface, incentives were shifting in ways few fully understood. Risk was being reallocated, not eliminated. Safeguards weakened quietly. Behavior changed slowly, then all at once. Companies learned how to exploit the new framework. Financial institutions discovered ways to stretch balance sheets further than before. Growth accelerated, but so did dependence on the rule itself. The early reveal appeared in the data, not the headlines. Leverage climbed faster than output. Profits rose, but resilience declined. The system became more efficient and more brittle at the same time. Small shocks produced larger reactions. Recovery required more intervention. Each cycle leaned harder on the same rule to keep momentum alive. Most people didn't notice. Why would they? The economy looked strong. Jobs were plentiful. Markets were calm. The rule felt invisible. But invisibility was its greatest danger, because once an entire economy adapts to a single assumption, changing that assumption becomes almost impossible. And the rule that promised stability was quietly setting the stage for transformation, whether anyone was ready for it or not. As the years passed, the rule began shaping behavior in ways its creators never intended. Financial institutions optimized around it, building strategies that only worked as long as the framework stayed intact. Risk models adjusted. Lending standards loosened. What once felt exceptional became routine. The reveal deepened when competition intensified. Firms that embraced the rule aggressively outperformed those that didn't. Returns looked stronger. Growth appeared faster. Caution started to look like incompetence. Slowly, reluctantly, even the most conservative players adapted, not because they believed in the rule, but because survival demanded it. Households felt the shift too. Credit expanded. Borrowing became easier. Consumption rose. Asset prices climbed, reinforcing the belief that prosperity was permanent. Policymakers celebrated rising confidence as proof that the economy had entered a more efficient era. But efficiency has a shadow. It leaves no room for error. The early conflict emerged when small disruptions began producing outsized effects. A modest slowdown caused sudden tightening. A minor policy hint rattled markets. Volatility spiked in places it never used to. Each reaction required more intervention to restore calm, as if the system had lost its natural ability to absorb stress. Inside regulatory circles, concern quietly grew. Analysts noticed that buffers were thinner. Leverage was higher. Dependencies were deeper. The economy wasn't just benefiting from a rule, it was relying on it. Any reversal, even a partial one, risked unraveling years of behavior built on the same assumption. Yet, changing course felt impossible. The rule had reshaped incentives across every layer of the economy. Removing it would mean slower growth, tighter credit, and political backlash. Keeping it meant drifting further into fragility. Policymakers were trapped by their own success. The system moved forward, stronger on the surface, weaker underneath. And with each passing cycle, the rule tightened its grip, not through force, but through dependence. The question was no longer whether the rule had changed the economy. It was what would happen when the economy could no longer function without it. The strain finally surfaced during a moment that should have been manageable. Growth slowed slightly. Nothing dramatic. No collapse. Just a gentle deceleration that, in past cycles, would have passed unnoticed. This time it didn't. Markets reacted sharply. Credit spreads widened. Lending paused. Asset prices wobbled, as if the ground beneath them had shifted. The rule that once smoothed fluctuations now amplified them. A system optimized for efficiency had lost its tolerance for friction. The conflict intensified as policymakers attempted small adjustments. A minor tweak here, a clarifying statement there. Each move was meant to reassure. Instead, it exposed how sensitive the system had become. Markets overreacted to every hint of change, swinging between relief and panic within hours. Stability no longer came from fundamentals. It came from expectations. Businesses felt the pressure immediately. Financing that once flowed easily slowed without warning. Projects were delayed. Hiring paused. Firms that had expanded aggressively under the rule now struggled to adapt. Their margins were thin. Their buffers shallow. The same framework that fueled their rise now threatened their survival. Inside financial institutions, stress tests began flashing red. Models showed cascading failures under scenarios that once seemed unlikely. Leverage that had boosted returns now magnified risk. Portfolios built around the assumption of constant support faced sudden uncertainty. The system wasn't breaking, but it was revealing its fault lines. Public confidence remained intact, but institutional confidence eroded. Executives spoke cautiously. Regulators held closed-door meetings. Everyone understood the same truth. The economy had been reshaped around a single rule, and that rule had become too big to touch. Yet leaving it unchanged carried its own danger. Every cycle pushed risk further forward. Every intervention made the next one more necessary. The economy wasn't adapting. It was accumulating tension. And like all systems built on a single assumption, it was becoming vulnerable to the moment that assumption failed. The rule had delivered growth. Now it was delivering fragility. And the window for easy choices was closing fast. The climax arrived when policymakers faced a decision they had spent years avoiding. The rule could no longer remain untouched. Inflation pressures mounted. Financial imbalances grew too large to ignore. What once looked like fine-tuning now demanded a fundamental shift. The announcement was cautious, carefully worded, designed to sound incremental rather than transformative. But markets understood immediately. The assumption that had supported an entire economy was being questioned, and questioning it was enough to shake everything built on top of it. Reactions were swift. Asset prices recalibrated. Credit tightened. Volatility surged in places long considered stable. Businesses scrambled to adjust plans built on cheap, reliable access to capital. Households reassessed debt they had assumed would always be easy to service. The rule hadn't just guided behavior, it had defined it. The resolution unfolded over months, not days. Growth slowed, excess unwound. Some sectors shrank, while others adapted. The transition was painful but clarifying. The economy discovered what had been masked for years. Real strength doesn't come from perfect efficiency. It comes from flexibility. In hindsight, the rule wasn't a mistake. It was a lesson. It showed how powerful incentives can be and how dangerous they become when left unquestioned. Small policy choices don't stay small. They compound. They reshape behavior. They change the future in ways no model can fully predict. Modern relevance is unavoidable. Today's economies are shaped by rules as much as by markets, and every rule carries consequences beyond its intent. Understanding those consequences before dependence sets in may be the difference between adaptation and crisis. The rule changed an entire economy, not by force, but by quietly teaching everyone how to behave. And once learned, those lessons were hard to unlearn. Subscribe to join the journey. The rule